Let us now quickly revise Accounting Standard 13, which talks about investments. Starting with the definition of investments. Investments are assets which are held for the purpose of dividend, interest, rent, or for the purpose of capital appreciation. The scope of the standard specifically mentions what are the items against which Accounting Standard 13 cannot be applied. You cannot apply this standard to recognize income by way of dividend, interest, and rent. To recognize dividend, interest, and rent, no, Accounting Standard 9 is to be followed, not Accounting Standard 13. Accounting Standard 13 helps us understand how to account for investments, which will fetch us interest, dividend, and rent. And if you bought any specific asset, to give it on lease, either in the form of operating or in the form of finance lease, though you have invested money in the same, you cannot treat that as an investment under Accounting Standard 13, because there is more detailed Accounting Standard 19 which talks about how to deal with assets that are let out on lease or which are purchased on lease. Then talking about the last part, if in case you have an obligation to give a defined benefit to your employee at the end of his employment term, and to give the money like gratuity or any other funds to him on retirement, you are saving up some money at the end of every period. Such an amount is called as plan assets, and such an amount of investment made in mutual fund or in terms of equity instruments or debt instruments or in any other form to meet the requirements of retirement benefits to be given to employee will be specifically covered under Accounting Standard 15 employee benefits, and you should not try to account it under Accounting Standard 13, which talks about investments. Talking about investments, it can be majorly classified, like how I do is investment properties and financial instruments. Investment properties are investment in land, building, or anything of this sort, majorly for the purpose of capital appreciation. And this is the excess money in the business that's kept aside, and this is not in the ordinary course of operations. This is not to be used in the ordinary course of operations. So these will be majorly treated like Accounting Standard 10 PPE, and there is no great discussion about these items in 13, but they are covered under 13. But accounting is done under 10. Talking about financial instruments, debt instruments, equity instruments, all of these are majorly classified into two categories. One is current investments, other one is non-current investment. Whatever items which are expected to be sold within 12 months or you intend to hold it not longer than 12 months are current instruments, and they should be readily marketable. If they are readily marketable or readily realizable or readily convertible into cash and you intend to hold it for less than 12 months, then it becomes current investments. On the other hand, if it is not a current investment, it will be called as non-current investment. Why do we classify a financial instrument held as an investment into current and non-current? This is because the way we account current investments and the way we account non-current investments is different. Current investment is valued at cost or market price, whichever is less. However, on the other hand, a non-current investment is usually valued always at cost. However, whenever there is decrease in the price or the market price or fair market value, whatever you call by, of a non-current investments, and such decrease or dip is permanent in nature, it's not going to get recovered, then you provide for such loss and decrease the value or cost of that non-current investment. Otherwise, a non-current investments will be always valued at cost, and our current investments on every balance sheet date will be restated to cost or market price, whichever is. Now, the next is the discussion on cost. What and all does cost include? Cost includes purchase price that you incur to buy the specific instrument. If in case you paid some brokerage, registration fee, stamp duty, security transaction tax, anything in this context, that will also be added to the cost of the asset. And if in case you have purchased this specific instrument on a date other than the date on which dividend is issued, or on a date other than the date on which interest is issued, then that instrument what you buy would not just include the price of that instrument, but it will also include the accumulated interest or accumulated dividend. This has to be eliminated. We need to record the investment in the form of debenture at X interest price and share at X dividend. But share, the context is slightly different. I'll come back to it slightly later. Whenever you buy a specific debenture, there is a possibility that the seller will recover interest accrued till that date from us. We need to identify and eliminate that interest and then take the price. If they give cumulative of interest, we'll eliminate the interest. If they give excluding interest, when interest is not included, we'll take the tax interest. Brokerage as a percentage when it is given in the question, brokerage or stamp duty as a percentage when it is given in the question, to be computed on X interest price or cum interest price. whatever is mentioned to us in the question. If the question gives X interest price, on that we'll compute brokerage. If the question gives come interest, on that you compute brokerage and then eliminate interest. You get this? This is because broker charges the brokerage on the price that we agreed or mentioned in the agreement. And we believe that the transaction price what they've given to us in the transaction is the price at which the agreement is entered between the buyer and seller. Then same thing, talking about interest, dividend and rental. These are incomes and it should be transferred to P&L. This cannot be capitalized, cannot be included in the cost. If in case we compensate the seller for some amount of interest or dividend, what he has earned but we will receive, that has to be eliminated from the price. And what if there is non-cash consideration, meaning we have purchased a specific instrument but we have not given cash, we have given another financial instrument, or we have given asset in any other form as consideration. That specific asset what we receive as investment, in this case, no, unlike and always commercial substance is there, because no two instruments will give same financial return, cash flows will be different, so it's always like commercial substance is there. So the asset that we received for non-cash consideration should be recorded at the fair market value of the consideration given, fair market value of the asset sent or fair market value of the asset received, whichever is more clearly and evidently available. If both of them are very clearly and evidently available, priority 1 is given to fair market value of the asset given away. After this, let's talk about the treatment of dividend. A minute ago, I told you we'll discuss later. This is the context. So dividend can be treated into two times depending upon the point of holding. One is pre-acquisition dividend, other one is post-acquisition dividend. What do we mean by pre-acquisition dividend? So now whenever the company declares dividend, the period for which the company is declaring dividend, during that period, say the period for which the company is declaring dividend, during that period, if you are the holder of share, that is pre-acquisition dividend, sorry, post-acquisition dividend. If in case you bought the share after the period for which the dividend is declared, it is pre-acquisition dividend. Let me give an example. Let us say company is giving dividend for the year 2023-24. The dividend for the year 2023-24 is issued in 24-25. In the year 2024-25, let's say some date in the month of July, when we are receiving dividend, when we are receiving, I bought the share in April 2024. I'm receiving the dividend in July, but I'm receiving dividend for April to March 2023-24. So from April 2023 to March 2024, I was not holding this share. I bought this share only in April 2024. Now I'm receiving dividend in July. So this dividend is from the profit for the period during which I was not the shareholder. So this dividend is pre-acquisition dividend. Let us say instead of buying the share in April, I bought the share in March. It doesn't matter what date. Let's say I bought the share in March 2024. Then in the month of July, company is declaring dividend for April 1st, 2023 to March 31st, 2024. During that financial year, I've been holding the share. So the dividend that I receive in July is post acquisition. After I bought the shares, I've received the dividend. If in case the dividend is pre-acquisition dividend, it is not my income. I have not earned that dividend. So this dividend belongs to the holder of the share in the previous year. So the holder of the share in the previous year, when he sold the shares to me, he would have sold it at a price higher than the normal price. So the purchase price, what I've recorded in my investment account on the debit side, would be cumulative of dividend price. But unlike debenture, I cannot deduct it at the time of entry because on the date when I purchased, I don't know how much of dividend. So I would have recorded at cumulative dividend price only. On today's date, when I get to know the dividend, I would have to reduce the cost, what I already recorded in my investment account debit side. But I cannot change the entry what I have recorded long ago. So what do I do? To reduce the cost, I'll write the pre-acquisition dividend in the amount column on the credit side in investment account. If I write dividend received for the pre-period in my amount column in the investment account on the credit side, it will decrease the cost which is recorded in the debit side in the amount column on the investment side. On the other hand, if the dividend is post-acquisition dividend, this is received for a period after I acquired the shares, such dividend amount will be written in the dividend column because it is income which will go to P&L. By writing pre-acquisition dividend in the amount column, we reduce the cost. By writing dividend in the dividend column, we treat it as income and post it to P&L. That's the difference between pre-acquisition and post-acquisition. Pre and post-acquisition dividend concept comes up only and only for final dividend. That is dividend declared by the company in the general meeting for an entire year. However, between two annual general meetings, if the company declares dividend, that is called as interim dividend. So during the year you're holding the share, during that year only you receive the dividend, you have already acquired the shares and they've given the dividend. So interim dividend is always post acquisition dividend. This will not be adjusted against the cost. Post acquisition dividend will be returned to P&L account. So you should write it in the investment account in the dividend column, not in the amount column. That's with regard to interim dividend. Then talking about shares. So company can issue two types of shares other than the normal issue. After you have acquired the shares of a company, you can receive bonus issue. You can receive whenever the company gives you bonus issue, it is free shares received. It is capitalization of reserves. With regard to bonus issue, only the nominal value of the shares is increasing, but price is not at all increasing. For the sake of accounting and for disclosure purpose, you will prepare one column in the investment account called as nominal value column. This is not the amount column. This has no significance. Just to ensure that dividend can be computed with ease and disclosure requirement is fulfilled, we'll write that dividend. We'll write that nominal value column. So whenever bonus shares are received in the debit side in the investment account, write two bonus shares. It is not a proper journal entry. Just write two bonus shares and write the amount only in the nominal value column, nothing in the dividend column, nothing in the amount column. So only nominal value of the shares will increase because of bonus issue. And after this, if in case there is sale of shares, don't say bonus shares are sold, so purchase price is zero, entire sale consideration is profit. That should not be how we account it. Should always remember that once the bonus issue has happened, share value in the market will get averaged out. So we take the opening shares held plus bonus shares. That will become our denominator. And the cost that we had incurred for acquiring the opening shares, that will be the numerator. So total value of the shares before bonus issue divided by shares before bonus plus bonus shares, that will give us the average price. And this is the average cost of bonus shares even when they are sold. So don't write the total sale value of bonus shares as profit. You need to find the average cost and then determine the sale consideration and profit of bonus share. If in case it is right shares, all we need to remember is right shares whenever it's given, the investor has three options. One, to subscribe the shares. Two, to renounce his options. Three, to do nothing. If the subscriber, if the right shareholder subscribes to the shares, it is a normal purchase entry, but the entry will be at right issue price. So we'll write bank account debit to investment in shares. So in investment in shares account, you'll write on the debit side 2 back. Write that amount in the amount column, and that's it. Very simple journal entry. If in case this shareholder renounces his right, sells his right to some other person. Remember, he's not selling the share, he's selling the right to buy the share. That sale consideration, that is number of rights sold multiplied by right value, whatever consideration you get, this has to be taken to P&L account credit side. This has no place in investment account. It has to be taken to P&L account credit side. This has no place in investment account. However, there is an option given in the standard. This is not mandatory. This may be followed. This may be followed. This is when you bought the shares today and immediately company announced right issue, and right after that share price dipped. And during this you sold the rights. So you purchased the shares at cumulative right price, and the company made right issue, and right after the right issue share price in the market dipped. In that case, whatever the number of rights you sold multiplied by selling price, whatever you get, instead of taking it to P&L, and here these shares X market price decrease, no. So when you take the cost will be at cumulative right price, and then the closing balance number of shares will be at theoretical X right price is their market price. When you do cost or market price, whichever is less, it becomes less, and such loss will go to P&L account debit side. So sale of rights income you wrote to P&L account credit, cost or market price, whichever is less when you did less, that also goes to P&L. So one is expense, other is income. Instead of writing expense and income in P&L, that income what you get by sale of rights, you have an option to reduce the cost of the investments using this, to ensure that there is no separate charge to P&L. So this is just an option given. So I'll repeat this again. Whenever the right options given by the company to the shareholder are sold by the shareholder, sale consideration, that is number of rights multiplied by right issue price, will be transferred to P&L account credit side. However, if the shareholder buys the share at cumulative right price and immediately after the purchase, company goes for right shares, and then investor sells his rights and there is decrease in the price, then the investor has an option to take that consideration in the amount column on the credit side in investment account to adjust the cost. This is just an option given. And the last one, if in case the shareholder does nothing, and say it doesn't buy the share, doesn't sell the right, you also do nothing and eat this 5 star. Don't eat it because I want it here. And the last part is reclassification. When you classified an investment as long term, thinking that you will hold it for long term, period longer than 12 months, and later you feel like no, you want to dispose it, you want to reclassify it to current investment now. Then what should you do? Such an investment which was long term, which is now about to be shifted to current investments, should be valued at the original cost or carrying amount what is there. Carrying amount might be different from original cost only and only when there is huge decrease in the value of that long term or non current investments that is adjusted. Otherwise, that long term investments will be at cost only. However, if it was huge decrease and it is recorded, that carrying amount will be less, cost will be more. Whichever is less will be considered. Got it? However, in a vice versa scenario, you have initially recognized an investment as current investments, which is expected to be sold within 12 months. Then you see a long term potential in this investment and you want to reclassify it to long term. When we do that, you need to do it at cost price or fair value, whichever is less. Fair value here refers to market price. And this is how we value or count for investments.